Welcome to this explainer. Today, we're diving into the absolute bedrock of personal financing and long-term wealth building. We're literally unpacking the mechanics of exponential growth. Seriously, if you've ever wondered how ordinary, everyday people manage to build these extraordinary nest eggs over their lifetimes without winning the lottery or inheriting some massive fortune, you are in the exact right place. We're going to explore the specific mechanics behind this phenomenon, using clear numbers and undeniable math.
All right, to start things off, I want you to picture a seemingly insignificant amount of money, just $100 a month. When you're structuring your daily financing, $100, it really doesn't feel like a life-changing sum of money. For a lot of us, it represents, a couple of takeout meals, maybe a few streaming subscriptions, or just some random weekend expenses that kind of slip through our fingers without us even noticing. It's an amount that is incredibly easy to just spend and forget about completely.
But this brings us to a massive, game-changing question. Could this seemingly small habit, putting away just $100 a month, actually grow into hundreds of thousands of dollars? Okay, let's dive into this. To the human brain, which is totally wired to think in straight lines and simple addition, turning a small monthly habit into a mountain of wealth can be really hard to intuitively grasp. But the mathematical reality of long-term financing relies on a completely different kind of math.
Section 1. The Secret Engine. Now, what's really interesting about this slide is that this isn't about guessing the next hot stock, it's not about complex trading algorithms, and it is absolutely not about luck. It's all about compound interest, which essentially means you earn interest not just on your original money, but also on the interest you've already earned. Let that sink in for a second. In the very beginning, your money goes to work for you, right? It earns a little bit of interest. But then, in the very next cycle, that new interest joins your original money on the front lines. Your money makes money, and then that new money makes even more money. It's literally like a financial snowball rolling down a very long hill, gathering more and more momentum with every single rotation.
And just to prove this isn't some nice metaphor, here's the actual mathematical formula powering this entire engine. FV equals PV times 1 plus R to the power of N. Future value equals present value multiplied by 1 plus the interest rate raised to the number of time periods. You see that little n up there as an exponent? That is where the real magic lives. Because we're not talking about simple multiplication here, we're talking about exponential growth. That tiny little exponent is the undeniable math behind wealth creation. It dictates that as time goes on, the growth doesn't just chug along steadily, it accelerates wildly.
Section 2. 10 to 30 years. Let's move to and see how this builds.
So let's actually apply this formula to the real world. Say you decide to take your financing seriously and you start investing $500 a month at an average 10% return for 10 years. Your actual out-of-pocket investment, the money you physically worked for and contributed, is roughly $60,000. But look at the total value of the account on the right. Because of the power of compound interest, your account could be worth around $100,000. You only contributed $60,000, but you have $100,000. That extra $40,000, it didn't come from your paycheck. It came purely from your money working for you.
And this brilliantly illustrates what happens when we let that n in our formula, time, really stretch out. Let's keep that exact same pace going for 30 years. Over 3 decades of consistent $500 monthly contributions, your total out-of-pocket investment would be $180,000. But look at the staggering result on the right. No, your eyes are not deceiving you. That steady, disciplined investment could explode to over $1 million. Let me just repeat that because it's insane. You put in $180,000, but the account is worth over $1 million. The vast majority of that wealth wasn't money you saved. It was money that your money generated all by itself.
Section 3. Time beats timing.
When people see that $1 million figure, they almost immediately think they need to become some sort of financial expert to actually achieve it. They think there's this secret club of investors who just know exactly when to buy and sell. Let's completely dispel that major myth right now. There's this massive false belief that successful long-term financing relies on finding the absolute perfect investment or perfectly timing the stock market. But the truth? It's far simpler and way less stressful. The real secret isn't outsmarting Wall Street. The secret is simply starting early and staying incredibly consistent. The math we just looked at doesn't care if you're a financial genius. It only cares that you give it fuel, your consistent contributions, and a long enough runway to finally take off.
So, the crucial point is simply this. Time beats timing. It's a profound, undeniable truth in personal finance. The sooner you start investing, the harder your money works for you. Even really small amounts, if given enough time to compound, will eventually outpace much larger amounts that are invested later in life. Obviously, you can't go back in time to start earlier, but you can absolutely ensure you don't delay starting today.
As we wrap up this explainer, I want to leave you with a thought to really chew on. Look at your own finances. Take a look at your savings.
Think about that unstoppable mathematical engine we just uncovered today, and honestly ask yourself, how hard is your money working for you right now? Is it just sitting there idle, or is it out there, gathering momentum, earning interest, and actively building your future? Thank you so much for joining me to explore the sheer power of compound interest. Let this math inspire you to take action.